So this morning I'm going to tell you, within the 1 hour I have, I'm going to talk to you about environmental liabilities for businesses from a legal perspective, since this is what I'm trained in. This topic is dear to me because that was my PhD topic. My approach will therefore be limited because the legal system is a vast topic and you can only take a single approach under one angle. In 1 hour, I cannot do much more and look at all the aspects of the legal system. So this idea of environmental liability is a point of focus on the issue of the risk for the businesses, especially from a legal perspective. We are always looking at this environmental liability, which is equivalent to capturing the environmental risk for business. And this is why I decided to write my PhD on it. So more specifically, this idea is found most specifically when a business is being transferred. So it's when you want to transfer a business that we want to look at whether there is a liability in terms of environment. Maybe a mistake, but this is the point in time in the life of the business where it's being looked at as a liability. So this is why in practice we have developed a guarantee clause for environmental liabilities. So this practice is already in place within the standard clauses, but this one is specifically focused on the environment and environmental liability. The purpose is to bring out any liability that would come up after the transfer, but the origin of which should be based before the transfer. This provision is trying to capture this risk of liability, of environmental liability, which is somewhat random. So this is the first definition that you can have. So this is this practice of having a guarantee clause regarding the environmental liabilities. This gives us an initial idea of what it might mean for a business when you're looking at transferring a business. We can take the definition a little bit further and try to define this idea of environmental liability. The best idea for me is to use accounting law as a base. So I'm going to talk about accounting law this morning, and very proudly, because I think not enough is made of it, and I'm going to rely heavily on it. So this environmental liability is a liability, and this idea of liability is well defined in the accounts and the accounting law through various rules and principles. This is why in this accounting approach, there's a definition with an exact outline that defines precisely this outline to capture this notion. But above all, to get back to the point I mentioned earlier, what's interesting about an accounting approach is when we're trying to capture it in the accounts, we need an approach that does not focus solely on that moment in time where the business is being transferred. So we need an earlier approach as soon as the business is being created, so that this risk can be captured and recorded from the beginning, not just at the point in time where transfer is occurring. So I think this is why this accounting approach is useful, because you can anticipate and not just look at that issue at the point in time where transfer is occurring. So regarding the accounting approach, so I'm avoiding any controversial issues. So it's the whole resources of the business, so the liabilities, internal or virtual liabilities, as well as debts of the company. That's the liability side. So we have the general ledger, the national general ledger, or plan comptable national. So there's a first chapter for shareholders' funds, and the second one is about liabilities, other liabilities. So this is the way this general ledger is structured. So this is a fairly broad definition. So on the one hand, shareholders' funds, and then other liabilities. And within the Code of Commerce, there is also another issue, which is also a broad definition, according to which the liability side of the balance sheet will show the first provisions, debts, as well as translation differences in addition to shareholders' funds and other debts, as mentioned. So in this definition of liabilities, we need to look at this National General Ledger, especially Article 321-1, which defines what the liability is. It is an element of the assets which has a negative economic value for the business, which is an obligation of the business towards a third party, which will probably or certainly create an output of resources to the benefit of that third party without a consideration at least equivalent to it. This obligation may be legal, contractual, or even it can arise from the past practices of the business, of its well-known policies or public commitments, which created expectations, legitimate expectations from the third parties concerned. So this obligation has a very broad definition regarding what liabilities mean. There is also in the accounts different varieties of liabilities. So that could be debts or the provisions, as well as contingent liabilities. So I'm going to cover each one of those. First, the debt side. This is the first type of liabilities. It's important and I think interesting to see that the accounting, the meaning from an accounting perspective is different from the one that is used in general in the civil laws. So that could be, this is the civil law is a reference for all legal practitioners, especially the Napoleonian codes from the 1800s, and we have a number of articles that have not been updated since. So under the civil code, what's a debt? It is an obligation looked at from the liability side. It is more specifically an obligation under which a debtor is an obligation against a creditor to complete a certain service. So in the accounting sense, debt is a type of liability, as mentioned earlier, and more specifically, it is certain liabilities, the maturity and amount of which are being fixed precisely. So we can't always see immediately with these definitions the differences between the definitions. So to look at the practical outcome, I wanted to use an example here, which is the sales of goods. We can take the example of a contract for the sales of goods. So using the Civil Code and Article 1583, it says that a sale is completed between the parties and the property is transferred by right to the buyer as soon as the type of goods and the price have been agreed, even though the thing has not been delivered nor the price has been paid. So a sale can be considered completed provided that the parties, so the buyers and sellers, agree on the type of thing and the price. So this is also called the exchange of consents. At that point, that's where property is transferred, and therefore there is a sale from a legal perspective. So under the Civil Code, the consent is the condition, especially within the contractual issues. So it doesn't need to have material possession of the goods. That's where there is a difference between the Civil Code and the accounting rules, which says that the debt towards a supplier is being recorded in the account at the point in time where the goods have been delivered or the service has been given. So there is a sale and the property, the title has been transferred under the Civil Code. The accounting can only be recorded as a debt at the point in time, cannot be recorded unless there's been the transfer of the goods. So there are discrepancies here depending on the reference. And this is why I want to highlight this, and I want to bring here Veronique's presentations. And I liked what she said about this particular reference regarding Winter-Tubner, regarding the political system. Winter-Tubner. There is a legal system, so I'm going to remain on the legal system, which is the single system for me, which has multiple subsystems, which can be the various branches of law, legal branches. Each branch has its own terminology, therefore its own vision of tangible transactions. And that can be an illustration here with the sale of goods. We can have a vision under the Civil Code or from the accountant's perspective, depending on the vocabulary and where it becomes difficult. It's when there is a conflict between those various branches and different terminologies, therefore a different way to envision the issue. So that's where there are limitations between the legal subsystems because they don't always understand each other, which raises issues. This is why it is useful to have an approach under the accounting law, because accounting, which I call an integrative approach, when we explore various provisions under one code or another, we looked at the accounting terminology can be found in every branch of the law. That's where it creates a space for dialogue between those various legal subsystems. And I like this quality of the accounting system, which will initiate the dialogue between the various branches, legal branches, and maybe at a certain maturity level where we have no other terminology other than the accounting terminology. And this is why we can have a reference, and which gives me a transition to the next subject, and where we can look at provisions, which can be taken into account and is being mentioned in the Code for the Environment. It's very interesting to have this accounting approach so that in some circumstances, subsystems can meet each other with their own terminology, which could induce limitations. So back to liabilities. So we looked at debts, which is the first kind of liability. The second one is provisions, which is also defined in the general ledger as a liability where neither the maturity nor the amount has been fixed precisely. This means there is a uncertainty, so there is a risk, and this is where the provision helps to meet this notion of risk for the business, which is not always the case with debt, because for debts, the outline is quite clear, the amount, the maturity are precisely defined, and there is not as much room for risk as for provisions, but provisions give us these linkages. Similarly, with contingent liabilities, here I copied the definition from a contingent liability as found in the general ledger, and where we see that uncertainty is even bigger, larger. And to compare those two concepts, it's a provision. So the contingent liability is an obligation which is neither probable nor certain when accounts are being put together. But this, the output of resources is not so. So we have those two notions, provisions and contingent liabilities, that help capture the notion of risk, which makes the accounting a useful tool for capturing the idea of risk through their definitions that have been tested. And as I said before, that you can apply this approach throughout the life of the business, not just at the point of transfer. So regarding now liabilities, because that's what we want to look at with environmental liability, we have two sources here. The first one is a recommendations from the European Commission dated 30th of May 2001 regarding the taking into account of environmental aspects within financial reports for businesses. And then there is a recommendations of October 2003 regarding the taking into account of environmental aspects in the accounts of businesses. So there is not a lot of convergence between, there's not a lot of divergence between those two texts. A first reaction for those two sources to define environmental liabilities. The first one could be disappointment, because since we are looking at environmental aspects, it is soft recommendations. They don't have this legal strength behind them. And there's a second reaction, which is after once you look at those recommendations, we realize that they simply add an environmental varnish on the idea of liabilities as we looked at earlier on. So those recommendations give this environmental varnish, that's something, but finally it doesn't change anything to the idea of liability that we already have. The second recommendation for the National Council for Accounting says that it will be recorded as a liability is that there will be an output of resources based on an event that was happening in the past. And if there is a certain reliability in these events, we also note that the recording into the accounts may be legal or statutory or contractual. So there is this idea of a future event based in past events. So again, there is it copies the idea of liabilities and risk, but we add the idea of environmental issues. The recommendation also adds the idea of expenses in the environmental sense. So this means prevention, reduction, or correction of damages to the environment. And this output of resources must have as its primary objective is the protection of the environment. So this is when it is an expense for the environment. So this conceptual basis is unchanged. It's standard liabilities with this environmental varnish. Even if there was an attempt to try what an expense could be in this sense. To add to this idea that there is no change to the substance, we can look at the preamble for the French recommendations, which says that it's not only going to look at accounting and financial elements in terms of environmental issues. Same with the preamble of the European recommendations, which states that this recommendation does not have a specific target in environmental reporting, but it's looking at the rules of the accounting insofar as it is showing in events and transactions which could affect the financial situation of the company. So we are going to look at this environmental information only if it has an impact on the financial situation or position of the company. So this is how it's being deciphered, based on the preambles for both recommendations. So this is where we go to the conceptual basis for accounting law. So to find it, I've shown not comprehensively, but a few articles and provisions to help capture this conceptual basis with a financial angle. So these are the provisions within the Code of Commerce. Since the law of 1983, there are accounting provisions that have been added. For example, Article L123-14 of the Code of Commerce says that the accounts must be true and fair and give a fair image of the assets, financial position, and benefit of the business. So again, that's what we're looking at, this financial position. The paragraph 3 shows if exceptionally applying one of the accounting rules does not help give a fair picture of the assets, the financial position, or benefit, an exemption should be applied. You can see the same thing with Article L123-15, first paragraph in the Code of Commerce. I'm not going to read it. It is on the screen. And again, in bold, you see the words financial position. And again, we have this same attitude in Article L123-17. So always the need for a fair picture, fair view regarding the financial position of the business. Also used one of the provisions in the general ledger, national general ledger, which says that accounting is an organizational system of financial information to capture, order, and record figures, data in the shape of figures, to give a true and fair picture of the assets, financial position, and benefit of the entity. So this basis, this concept, requires taking into account the financial capital of the business. So, as Jacques Richard mentioned, regarding what is a true environmental form of accounting, we are looking at this way to decipher the issue. And we have an external and internal view. So this financial view, even for non-financial elements, such as environmental or social, but it's always under a financial view. So there is a whole conceptual basis which gives an orientation to the way this issue is being captured. And this needs to be highlighted. It becomes a problem currently when various stakeholders are trying to try an ecological approach. They're going to have costs. And that's why the CARE methodology is bringing about. So there are costs to maintaining the natural capital. So these costs are being borne by those who are trying to apply this approach, and it will translate into the profit and loss accounts, but that others won't have. So the current accounting principles are being penalizing those who are trying to do a transition in favor of the environment, and we can't see the compensation or consideration that they get, which are trying to express their desire to maintain the natural capital. So this filter, this financial filter, makes it hard to capture the risk to the environment, and that's why we need a multi-capital approach like the CARE methodology is trying to do, to get a better perception of the environmental risk for business more generally. So we're trying to add and to modify this basis to avoid this filter that's entirely financial. So you can see this key notion in the CARE methodology, which is the capitals. As a simple definition, I like what Alexandre Rambaud says, which is the things we hold dear. It's very interesting to give a material reality to this capital. These are the things we hold dear. So if you're trying to mesh it with a legal approach, this idea of capital is not a foreign concept for the legal profession. And there is the notion of social capital. So this is interesting when you're looking at the business law. So this social capital, we also want to maintain it through the principle known as intangibility of the social capital, or this fixed aspect of the social capital, under which principle the partners cannot ask for repayment of their contribution as long as the capital needs to be maintained. Through this rule, so that the shareholders' funds need to be maintained and fixed. It is therefore forbidden to distribute the shareholders' funds in the shape of dividends. So there can be an exchange between the legal profession and the accounting profession on this issue, especially on the business law. So we would like to get to an integration, a legal integration, so that it's not viewed entirely financially, but by introducing new forms of capitals, so natural capital and human capital. This is why the accounting law, I'm sorry because I didn't move the slides along, so it doesn't, what it says on the screen has nothing to do with what I just said. So in terms of progress for the accounting law, the input will be the accounting law. It's not going to be the law for the environment. It might sound quite obvious. So the entry point, I wanted to highlight this point because when we're trying to capture environmental risk for the business, that's what I'm trying to imagine to get away from my position as a legal practitioner. We want to, maybe we can be tempted to think that the environmental law might be the way to capture those risks in the accounts, but that is not the approach that I'm choosing today. We'll get back to it. It's more the law of economics and accounting law. So the starting point is not the environmental law. So this, if the purpose is protection of the environment, this is a new notion that dates back from the 60s or 70s, because the environmental law is derived from health and hygiene laws. It is presented as a recent type of law that has a key basis on the protection of the environment, and that there is a decree of 1810 which sets up a requirement to obtain permission for dangerous work for businesses. So why this reference to 1810? So it demonstrates that initially we were looking at these environmental issues to give, to allow polluting activities, but within a framework of rules. But they are still polluting activities. So I think it was interesting to bring this historical reminder. In the recent concept, so going back to that, so environmental law has as its aim the protection of the environment, especially from the 60s and 70s. This environmental law is a right for administrative policing against damages and abuses. And so this administrative side gives a vertical constructions of the law, so where the business is the target and recipient of the regulations. That used to be very true at the beginning of the 70s. But since the end of the 80s and a much greater pace of progress more recently, there are a massive use of tools which belong to business world and business relationships, which have more to do with markets and businesses. So these tools which are within the environmental law has changed the way this environmental law is looking. So I have relied heavily on Gilles Martin's work, who looked at this very closely and who looked how the environmental law has evolved with adding economics tools, especially with greenhouse gas emission quotas. So we can see that there are tools that are getting involved into the environmental law. It is important even for legal practitioners that specialize in the environment. It's important to understand those tools, to understand the changes at work. So this is the first thing that might be highlighted. It is also useful to highlight how this environmental requirements have gone further and reached other legal branches. For example, business law. So this aspect is now involved in other types of laws. It's very interesting to look at both approaches and evolutions. So this is where we can look at the economic law of the environment. So this particular descriptor has much to do with Gilles Martin, and there's been much that's been written in his name for an economic law of the environment. And I want to highlight that this economic law of the environment regarding research that have started in a new research project, which is steered Oxto Wergenstein and Gilles Martin, which is the ecological transition, which looked at this dimension. And it started last June with a seminar in Paris, which is going to happen over 2 years. And it helps pinpoint the importance of this particular field.
To come back to business law itself, we can see a business interpretation or business-based analysis of law and a legal analysis of the economy. Now I'm taking the ideas of Gérard Verja, who emphasized that this law served to discipline the economic system and led to the emergence of legal regulation of the economic system. That's his first point. The second point is that this legal regulation of the economic system helps to identify the values underpinning the system. So business law can find several means of support, several footholds, including environmental law, the law regarding businesses in difficulty. When you look at all of the scope of business law, there are any number of possibilities. So you can still remain within the scope of economics, and of course use business law, accounting law the same way. The first point for an economic foothold, to formulate this in simpler terms, it comes back to looking at accounting or accounting law as it is today. From a critical perspective. So we can use accounting while looking to identify the values underpinning accounting rules. But in order really to implement this approach, you have to emphasize the fact that accounting is not a neutral practice. Now, this might be clear to you, but I think we do have to emphasize it because when we look at figures, the average legal expert might figure that figures are neutral, and yet the fact that these numbers are part of the arsenal of business law, they reflect also values, underlying values, and so they have to be questioned. They are not neutral. So using this margin of value, this leeway of value, it's possible to orient a company's approach. René Sabatier talked about accounting law in favor of, at the service of humanity. He says that that accounting techniques are set by law for the benefit of humanity, but they're simply tools. The human populations that use them in pursuit of the common good. I think I like this quote from René Sabatier because it really points out the importance of a legal dimension for accounting. Perhaps today more than ever, from a democratic standpoint. And from this democratic standpoint, it seems essential to see that all issues surrounding accounting are not only technical, they are also values that have to be identified, that have to be questioned in order to come to a collective democratic decision as to what we want to be included in business accounting, how we're going to organize the filters. And my fear today is that this questioning is not applied to law or by legal experts. Especially in a context of a growing influence of international accounting rules. So it's very important to keep in mind that within accounting we see values and not only techniques. The second foothold, an accounting foothold to legal regulation of the economic system. This is not a critique of accounting, but more of a perspective standpoint. How can accounting lead to a better understanding of environmental risks? Certain new values expressing new expectations have been included in accounting through law. One example is CSR, corporate social responsibility, which expresses this desire to include new expectations imposed on companies. There are also companies that have communicated on a voluntary basis environmental, social, societal information, in part to improve their image, but also keeping in mind that this information may have this non-financial information can also have an effect on their valuation, and so there's an open door between financial and non-financial. In France, the new law of November 15th, 2001, obliged companies to include non-financial information. This obligation has been extended to non-listed companies based on certain criteria, and this is called. This is in the Commercial Code, and it's called the Mandatory Non-Financial Declaration. And the Article 1933 of the Civil Code says that businesses must take into consideration, not take account of, but take into consideration non-financial aspects, that they may declare a raison d'être, encompassing the purpose of their activity. So for companies as legal persons, we see legislatures trying more and more to establish expectations vis-a-vis these legal persons, with an increasing focus on social and environmental aspects. Another interesting report from in recent years says that a report should be commissioned on the standards that should apply to accounting, because accounting is the basis also of the social impact of companies. What's interesting also is to see that this idea really delves into the heart of the economic system. For legal aspects, when we look at corporate law, we see that often the evolutions in corporate law do not really touch the foundations of accounting. So by taking action on accounting itself, as the example of care is a very good example, this will really delve into the heart of the economic system more than other approaches might. The idea would be to transform the conceptual basis of accounting law through a filter that would no longer be completely financial. When we cite this idea, the limits that are generally highlighted is that it's great to want to expand accounting law, but the limit would be that all accounting is based on legal rules, legal regulations. Like when I looked earlier at the definition of liabilities, that liabilities are defined by the legal system. And so the criticism is that these obligations could not be recognized by accounting. Now, I may not be seeing this argument correctly, but my vision is that we would have to wait for other branches of law. So for example, environmental law, we'd have to wait for these other branches of law to come up with rules or tests in order to really found or create grounds for these new assessments. What I'd like to develop here, I'm skeptical with regards to this approach. First of all, because I believe that this type of reasoning disregards the existence of accounting law. It denies the existence of accounting law and the fact that accounting law itself can be a source of obligations. This is more of a trend. Especially when I was writing my PhD, I looked at this accounting dimension through case law and saw that often when we look at this numerical analysis, the bases for case law were not necessarily strictly legal. Also, accounting law can be seen as a recent discipline. And what led to the emergence of accounting law is the need to produce high-quality accounting data, which goes back to the legal approach once again. Accounting can also be seen as an evidence-based tool, which means that the quality of accounting is extremely important. I'd like to go back to a few authors who have written about this. Précis Dalloz says that that accounting looks back to legal rules for its definition. Now, she was at the origin of accounting rules within the commercial code and said that the recognition of accounting rules by law is relatively recent, from 1983. An interesting parallel with the way that accounting can be taught in law school. My experience is that that the students would take accounting courses, and that the professors of these accounting courses are not legal experts, but accountants. And so they take a technical accounting approach. But we rarely see this a legal approach to accounting. The commercial code is very important when it comes to accounting, because in law, the first approach to accounting is through the commercial code, through commercial law. In the first year of law university, we see accounting issues, but through commercial law, not accounting for its own sake. The other original quality of accounting law is it's characterized by the diversity of its sources, which do not reflect the traditional pyramid of legal sources. So we don't see the same structure as within other fields of law, which can be disturbing for legal experts. To come back to this notion of originality, I'd like to cite Robert Taylor and Brigitte Riboud. There's another observation that's important in accounting law. I wanted to look at books on accounting law for lawyers. We have well-known works, mainly from the Dalloz publisher. I talked about the Dalloz earlier. So there's also accountability, accounting for legal experts from LexisNexis. And that goes back to what I was saying earlier with regard to the division between accounting and law in law universities. So this is the first work I know of that really comes into the nexus of these two traditions. We could say that as long as there's not a development in legal obligations that are the basis for accounting, then we won't be able to, then accounting law won't be able to evolve either. I think we cannot simply wait for other branches of law to develop in order to develop accounting law. The first point to justify the need to advance accounting law is that when legislatures look at bills, whatever the bill be, even if it's an environmental law, legislators don't necessarily look at the accounting consequences of legal obligations. So legislators will not think, how will businesses account for these obligations in their financial statements. So often we don't really perceive accounting law as a branch of law in itself, and so we don't really see the break between accounting law and other types of law, and the delay, the lateness, if you will, of accounting law. So we can see these new environmental focuses in many parts of business law, but less so in accounting law. So it's important not to take an entirely financial approach. Accounting law has to be seen as being able to reflect these new social and political focuses that define the 21st century. The issue is really no longer to move the problem, to see that accounting law would really be one of the centers to bring these new preoccupations into the legal world. So economic players it's a pity also when we see that economic players tend to have too much of a concrete focus. To conclude, I would like to say simply that accounting is really the backbone of business, of any human organization, because in addition to a business accounting, there's also public accounting. There's a new work on public accounting law, recently published in France. So the accounting is really a foundation, and that will influence also our prisms of how we see the world. Accounting is this decisive, and it's very important to emphasize this, since today there's a lot of talk about an environmental tax system, which is very important for legal experts. When we really understand the importance of accounting, then that leads to a certain skepticism, because taxable income is based on economic income. So I don't see how we could come to an idea of environmental taxes without basing it on accounting income. Once again, when it comes to sustainable finance, this is another domain that's developing very, very fast. but it's a domain that produces financial information. A transition to financial sustainability, in order to do this, perhaps we have to also look to accounting as a source of financial information. Once again, for an accounting-based approach, I think it's important to emphasize that it helps to take a comprehensive view of business. We can see that legislatures can intervene often on corporate law. They see that as the main entry point. But in addition to corporate law, there are other types of legal persons, and we cannot ground these new expectations only in corporate law. And one of the advantages here of corporate law is to see a broader view of business entities. Now, I'd like to talk about ecosystem-centered accounting. Unfortunately, I can't go very far with it because it's something I've only just started exploring. I don't have much insight yet into it. But I find it very interesting because and I'd like to go back to what Clément Fédère was saying. There is corporate accounting and public accounting, and perhaps there's a need to develop tools in the interactions between these two systems, and that really takes on full meaning in the framework of an ecosystem. Recently, I found a very interesting concept. Now we all know the famous CSR, but today there's a new system of territorial or local government social responsibility. This goes back to water resources or the idea of the commons. Now, and companies have to understand how to take this into account, but we have to go further than that. We also need to think of new forms of governance, but not only business government, but also local government, local public governance. Thank you very much for your attention.